previously on Rockstock channel.
Yeah, we raised about $6 million through a structured equity placement, rights issue and convertible note. So we look forward to sort of putting out the PFS and demonstrating what that could potentially look like.
Welcome back to Rockstock channel. It is Wednesday, November 27th, and we're here with a follow-up interview in our Getting to Know You series with Jindalee Lithium. Jindalee trades on the Australian Stock Exchange, ticker symbol JLL, and on the OTCQX, ticker symbol JNDAF. Current stock price is about the same as it was during our September interview, 23 cents, though the stock had spiked earlier this month to over 40 cents ahead of the publication of the company's pre-feasibility study for their McDermitt Lithium project in Oregon, which we will discuss today. At the same time, Lithium America's Thacker Pass got their loan programs office approval, which also influenced Jindalee's stock. Current market cap is 17 million Australian, or about 13 million US dollars. But Michael Bentley of Australian research and financial services platform MSD Financial recently published an update following the PFS and upgraded his target to $2.15 per share. If you'd like a copy of this note, you can find it at Jindalee's website, jindaleelithium.com, or you can email us at rockstockchannel@rkequity.com, or tag Rodney and me at RodneyHooper13 or Lithium Ion Bull on X. You could follow Jindalee on X at JindaleeL, and you can find the company and our guest today, CEO Ian Rodger, on LinkedIn. To be clear, Rodney and I are not strategic advisors to nor invested in Jindalee. And of course, we are not financial advisors, and nothing you hear today in this video should be considered investment advice. Please do your own research and read the disclaimer at the end of this video. And with that intro out of the way, welcome back, Ian. And Rodney is going to ask some questions about your PFS and any other updates.
Thanks for having me again, Howard and Rodney. Good to be here.
It's great, and congrats on completing your PFS, Ian. You've reached a big milestone in a market where many are cutting back and stalling. You've gone ahead and got it done. How important was the PFS to the company, and how long did it take to complete?
Yeah, thanks, Rodney. Yeah, look, it's a huge milestone for Jindalee. If you zoom out for a second, we discovered in 2018, we did a scoping study a couple of years ago, which never really saw the light of day, and was based on a different flow sheet. So this is the first time that there's been sort of parameters out in the market, that we think there's further opportunities clearly, but it's the first time that people can get, an idea of the size, scale, cost parameters, and the potential of this asset. And we're really happy with the outcome. We sort of, found our way to Fluor about 18 months ago, and they're obviously a large US construction company, engineering construction company, but one of the few groups involved who've got a significant experience in the lithium clays, having been involved with the two more advanced projects in Nevada. So we really think it's a high quality product. I'm pleased with what we've got to.
Okay, excellent. And so before we dive into the assumptions of the PFS, one thing that I've seen in the past that investors overlook in long life assets is that beyond sort of 10 to 15 years, when you present value earnings, it doesn't add much to the NPV. But with long life assets like yours, you can keep redoing, or it's almost like a perpetual NPV, because you can do it a few times in the future, given that you will always be generating, substantial value going forward, especially as CapEx is paid for upfront other than sustaining. So, I mean, if you look at it, Ian, I mean, it looks as if McDermitt's almost like three projects back to back.
I like that analogy, but yeah, I think you did right. I think it is sort of typically overlooked by investors, but there's a reason sort of majors target long life assets. They're exposed to. They know from history that 80% of earnings are generated in 20% of the year. So that just you get exposure to multiple price cycles over long life assets. And as you rightly point out, it's sort of like a annuity style valuation because once the capital's sunk, the NPV essentially remains the same for 30 odd years because it's such a long life asset. So,
Yeah.
and the other bit is the optionality, but yeah, we think it's very attractive.
Yeah, I mean, it's just something, that I kind of see as overlooked. Like beyond 15 years, if you do an NPV 8 or 10, it doesn't really show up. But you could do another exercise in 15 years' time and you're still where you were today, which another project would have run through its life. So it's kind of a hidden value thing. Um, just something that clearly applies to McDermitt because I see how much mining you've got and then how much processing. But again, you've probably got, fair to say, lots more resource that's not included in.
Yeah, there's I think our current reserve is about 11% of the resource base, and if you include a bit of the inferred, I think the whole PFS mine schedule is like 15% of the contained LCE. So we're really only scratching the surface. There's a whole lot of embedded optionality to look at expansion and stuff down the track, but yeah, it's a really big resource, and we think what we've demonstrated in the PFS is a good starting point and a solid foundation to work from.
And if we move to the assumptions that you've used, you've got $24,000 a ton, if I'm correct, sort of assumed flat through the life. That gives you an 18% after tax, post tax IRR, and I think it was 14.6 was your break even for the NPV. But again, a lot of the centers around CapEx, and that's really the main factor. You've got about 3 billion. If you can secure non-dilutive grants or low-cost funding, I mean, that changes everything. Where are you guys on that front, and how's that progressing to get that sort of game
Yeah,
changer?
yeah. No, it's a good question. I think before I get to that, yeah, I mean the pricing was based on long term incident pricing, similar to I guess a lot of the other groups. But I think one of the things we try to highlight in the PFS is that the OPEX and sustaining capital like still generates decent margins at today's pricing. But as you point out, the key is the capital, and being a US based project, we're eligible for those US funding pools that are just unheard of elsewhere in the mining finance world. Thacker Pass being the key example with sort of home loan sort of dollars in terms of tenor and treasury rates. But where are we up to? We've got a DoD grant afoot. We're expecting an update by the end of the year. We've been through a recent update, etc., with them, but that's the best guidance we've got around that, and that could materially co-fund the next stage of drilling, test work, and feasibility study, and really provide less dilutionary funding for non-dilutionary funding for that sort of key pre-development stage. We've through our advisors, we've had early engagements with some of the loan, the LPO and Exim and other avenues through the US government. I think we've been a bit early because we hadn't completed that pre-feasibility study, but we're sort of gearing up once the dust settles with the election, etc., to re-engage with those to put ourselves in the best possible position.
Okay, great. And then your C1 cash costs at around just under 8.7. Is there some scope for refinement and tweaking that in the future, going towards your DFS?
Yeah, absolutely. We think there's plenty of opportunity to bring that down and optimize through additional test work pre DFS. I think just zooming out for a second, I think to think about the opportunities is first thing to recognise is 70% of the OPEX is in the processing, and of that the single biggest input is reagents, in particular sulfur. So if you ever look at opportunities, the processing is two steps: beneficiation, upgrading the ore before a leach feed. And so any opportunities that you can knock out, acid consuming minerals, or while still preserving lithium in that beneficiation step, that materially reduces acid consumption and your capital intensity and operating costs, everything else remaining the same. So there's a bunch of opportunities in that space we've sort of identified through the PFS that be a focus of work, pre-locking the scope on a DFS. The other one is, well, it's cost related, but from a byproducts point of view, ability to really drive down the lithium unit costs. One of the big opportunities is magnesium. We actually produce a magnesium sulfate, which is a Epsom salts. It's a agricultural product and bath salt actually, but we haven't included any of that in the PFS, and there's further work to do around the market and test work. But we're excited by that potential. And then I think probably the other bit to add is, I think we spoke about last time. In September we signed a deal, a cooperative research and development agreement with the DOE, and they're working in consortium with some US research institutions, universities, as well as the Oregon Mines Department. And so their scope is really overlaps with these opportunities. One is focusing on beneficiation, the other is co-products, but then they're also working on a bunch of other stuff to improve sustainability outcomes and costs. So we're excited that work's being funded through the DOE, and it's only really starting now. So we're excited where that might lead.
Okay, great. So lots of scope. The other thing is, recoveries in the model were estimated at 84%. How does that compare to your previous test work?
Yep. So it's, all the recovery in the PFS is based on this the PFS test work program that started with Fleur's assistance in the middle of last year. So we did sort of bench scale test work from the beneficiation into the acid leach, and then we've done a bulk leaching to test the back end of the plant to produce the lithium carbonate, which we did in battery grade lithium carbonate in July. So those recoveries are all based on that work. I think one of the things that drive this sort of higher recoveries, particularly if you sort of compare it to some of the peers, is the smectite. Our smectite in the clay leaches has very good extraction rates at good acid levels, but also it's very quick. Sort of it goes in a solution within an hour. So and then all the previous test work to the PFS is sort of a bit irrelevant with testing different flow sheets, etc. So we're pleased with that outcome.
Okay, and then something I need to sort of raise, because we hear different things and markets change, is the question of whether there are any materials or reagent supply risks associated with the region or for the project.
Yeah, I mean, similar to Thacker Pass, require a number of reagents, sulfur being the largest. Luckily, we're sort of spoiled by US rail and road infrastructure. So the work we've done in the PFS gives us confidence that we'll be able to get access to those. But obviously, we're going to have to do a lot more market and logistics work as we go forward, and that speaks to how we might think about phasing and whatnot as well.
Okay, well, that's a good lead in, because my next question is, given the size of the resource and the limited percentage of the resource that the study was done on, is there sufficient infrastructure and labor and so on that you could potentially expand the project to phase 2, especially as your mining discontinues well before your processing life ends? If there is a high lithium price environment in the future, can you go bigger?
Yeah, I think there certainly is that potential, and I guess that's what Thacker Pass have done in their sort of DFS out of phase 1 to 40 and then phase 2 to 80. We've sort of stuck around that sort of mid 40s over the first 40 years. We did consider including it in the scope, but we really just came down to time and cost. And we expect to include some of that type of staging going forward. But as I sort of alluded to, we need to do more work in those sort of future phases to understand what the constraint is. At one point, logistics will become an issue. We don't think it is at the moment, but particularly if you're going for double or even bigger scale in a more bullish scenario, that may change how you think about the phasing. Otherwise, really just based on simple maths, like the incremental CapEx is lower for these sort of phasing, so you really get the benefits of capital efficiency and reducing your fixed, spreading your fixed cost base. So, we're excited about those opportunities. We didn't get it in the study, but we'll continue to work on that in the background.
So, Ian, what are the next steps for Jindalee from here?
Yep. Well, I think the key context is obviously big project, and so we had sort of a range of engagements with potential partners over the last 6 to 12 months, and the PFS is really the key document. So we plan to re-engage with interested parties with regard to the project over the next sort of 6 to 12 months, particularly given the size of the project. We think similar to, I guess, what a lot of our peers have done is, getting partners involved early can really help plug it into the value chain, but also then help unlock that future financing in terms of the loans and whatever else, while also sort of bringing some technical and processing know-how that can help in those sort of later stages. So I think we're focusing on that in the near term. We've just recently added a key hire in the US, looking to really enhance our permitting and community engagement work stream. So we see that as sort of a critical path, and we'll continue to work on that in the background. We have a key exploration plan of operation approval that we expect in the middle of next year, and that'll be a real catalyst for us to do a large infill drill program, which will generate sample and allow the potential feasibility study to happen around the same time. So that's the sort of the key bit in the short term. We're trying to focus on those critical path items while preserving the optionality on when we might want to do those larger cost work programs, in particular the drilling and the feasibility study.
And Ian, I know there's some funds available, but how do your cash reserves look, and how does your funding look going forward on sort of timelines?
Yep. I mean, end of September, we had sort of 3.4 million bucks in the account in the tin. Our major spend, if you look at our burn rate over the last year or so, on the PFS, it's been quite high. That's all sort of dropped off now. So, like I said, our strategy is sort of focus on those critical path items, limit our cash burn, and target the conversations with the partners, etc. We'll reevaluate in the middle of next year around what our funding requirements might be looking forward.
Okay, and then last one from me. The tariffs, they seem likely. Trump's victory and policy changes have yet to be fully laid out, but could this change things for Jindalee and secure you project funding and possibly a partner sooner? Tariffs, I would think, would play well for domestic projects.
Yeah, I mean, I think we're optimistic around Trump's direction. He as you guys know, he kicked off the focus on domestic critical minerals and this whole China decoupling supply chains, etc. When he was last in power, and we think he said as much to prioritize domestic production over the reshoring, which was seen to be a much more focus on so not reshoring, friendshoring in the sort of Biden years. So, there was going to be, cards to, he's going to play his cards over the coming year. But we imagine, there'll be some clarity in the new year, and we think that, the funding landscape might change. But I think the direction of travel is going to be positive for domestic projects like like Jindalee, as you sort of outlined, for those reasons that, the funding from the IRA and other programs have really gone to that downstream/green energy component, while that, the critical minerals, domestic production and the midstream component really hasn't got much dollars. So we expect that probably will change.
Well, yeah, just picking up on that point, Ian. I remember the deregulation push of the Trump administration last time. Thacker Pass got approved, I think, 5 or 6 days before Biden took over, and it was in some litigation, for a couple of years, but it did get permitted, and so did Ioneer. Actually, finally got permitted. So the last lithium bowl that we published, I called it, lithium sedimentality. It kind of like, what's the sentiment toward sediments? I mean, Elon Musk 4 years ago in Battery Day said there's enough lithium in Nevada to power all of the U.S., electric cars. And here you have, there's Hard Rock, there's, Salton Sea, there's Arkansas, and then there's Nevada Sediment. In both Ioneer and Lithium Americas, you have two companies that have announced making FID by the end of this year, both of which supported by large, low cost funding from the U.S. government, and both partnered with U.S. auto OEMs and ex GM in the case of LAC, Ford in the case of Ioneer, and Ford has a couple of others, I think, Sonic, as well as Echo Pro. So anyway, the sediment sentiment is improving, and both of those companies, like Jindalee, started out, as 15, 20 million market cap companies, going through the progress of pre-feasibility study and the like. So if you follow in their footsteps, it's not a straight line. It's often a bumpy road. But I think investors listening to the story, it can use those two examples as reference points for what could be possible at Jindalee over the coming years.
A lot of that sort of similar sort of approach is coming into our playbook for sure.
Sounds good. Ian, thank you very much for the update. Congratulations on a good PFS, and look forward to following your progress likely in the new year. It's getting toward kind of the end of the year. So enjoy the holidays and the new year. And, we'll check in again in January or Feb.
Likewise, gentlemen, great to catch up.